So in Unit 8, Learning Set 1, in this video, we're going to look at filing taxes when you withdraw early and employer-employee contribution to a retirement account. So in the first example, Xander is a 50-year-old man who files taxes separately from his wife. He has been making monthly contributions to his traditional IRA for many years. Last year, he entered into a new business partnership and decided to withdraw $50,000 from his IRA to make the initial investment. So he withdrew that $50,000 early. Xander's taxable income for the year, excluding the $50,000, was $97,000. How much extra did he pay in both penalty and taxes because of this withdrawal? So when you withdraw early from an IRA retirement account, you have to pay a penalty. So before the withdrawal, Xander's taxable income of $97,000 would have made his tax. So if we look at the tax table, $97,000, and he is married, filing separately, would be $21,539. So Xander's income after withdrawal from his IRA, so when he withdraws that money, it actually increases his income. So we take that $97,000, add the $50,000, so his new income is $147,000. And if you remember from our income taxes unit, we cannot use the tables because once you hit $100,000, you have to use the worksheet. So we're going to take the worksheet, enter in the $147,000 in the appropriate column, go through the process of calculating it, and our new tax, or his new tax, would now be $37,874.50. Now, when you withdraw early, there is a 10% penalty on any retirement account or withdrawals. So the penalty for Xander withdrawing early would be would be 10% of the amount he withdrew, which was $50,000. So he's going to have to pay a $5,000 penalty. So the combined additional taxes and penalty that he would have to pay, and what it would increase by, is the additional taxes would be taking the new tax minus what his tax was based on, $97,000, adding in the penalty of $5,000. So his additional tax and penalty increases his tax amount to $21,335.50. So in this one, we're going to look at employer-employee contributions to a retirement. So Leo makes $75,000 per year. His company offers a 401 retirement plan in which they will match 50% of his contributions. So not 50% of his salary, but 50% of what he contributes up to 6% of his salary. So the company allows employees to make contributions to the 401k to a maximum of 15% of the salary. So what this is basically telling us is they will match and pay up to 6%, but the employee can contribute more than that 6%. They can contribute 15% of their salary. So there is a max amount of what you are allowed to contribute to any 401k, and that max amount is $16,500 a year. So how much should Leo contribute per month in order to maximize his employer's matching contribution? So the maximum amount an employer would allow Leo to contribute is 15% of his salary up to $16,500. So 15% of $75,000 is $11,250. So his contribution alone does not reach that maximum amount. So the monthly contribution Leo can make would be $11,250 divided by 12, and that would equal $937.50. So that is the max that he can contribute. Now, if Leo only wants to contribute an amount up to his employer's matching contribution level of 6%, so that means he wants to put in the max amount that his employer could put in. So that would be $75,000 times 6%, divide that by 12, and that would be $375 per month that Leo would contribute. Now, if he contributed that 6%, how much would be contributed in all? So basically, if Leo contributes 6%, the employer will contribute half of that, which is 3%. So 75,000 times 3% is 2,250. Divide that by 12. The employer would contribute $187.50. Now, what would be the total contribution together? So the total contribution together would be Leo's amount of $375 plus the employer amount of $187.50, which means his total 401 contribution would be $562.50. And if we wanted to know what that would be annually, we would take that monthly amount, multiply it by 12, $6,750 yearly, and that is less than the maximum contribution allowed of $16,500.